Okay, everybody, we've got an amazing show for you today. My friend, Mark Suster, who is an investor, talks about the pivot he is doing at his venture firm. Really fascinating stuff. And we talk about a range of topics. This is one of those guests who's been on the program now 6 times. This was his 6th appearance, and he's going to be on every 6 to 12 months because, like Keith Raboy or some other folks we have in rotation, he's just that good. He's just that good. You're going to literally wish we had done 2 hours instead of the 1 hour. But I'm going to talk to you about Robinhood's earnings and Amazon going into big box retail. Stick with us.
This Week in Startups is brought to you by LinkedIn Marketing. To redeem a $100 LinkedIn ad credit and launch your first campaign, go to linkedin.com/thisweekinstartups. Twilio runs an amazing program for startups that includes a $500 getting started credit, access to webinars made exclusive for startups, $3,000 in SendGrid credits, and full support via their Twilio Startups team. Sign up now at twiliostartups.com/twist. And Fiverr Business is a modern workplace for the digital world. Their team of dedicated business success managers help match you with the best freelancers for your team. Right now, you can sign up for Fiverr Business free for the first year and save 10% on your purchase with promo code JASON. That's Fiverr.com/business and use promo code JASON.
All right, first up in our news rundown before we get to our interview, Robinhood doubled their revenue year over year, but their stock is down almost 10% due to warnings of a trading slowdown. Full disclosure / flex, I was one of the early angel investors in Robinhood before they even launched the product. So I still have all my shares, haven't sold one, don't plan on selling any of my shares. I will distribute my shares to my LPs in my fund, but I'm long the company. I think they can get to 100 million accounts, and that has never been done before, at least to the best of my ability. If you know of any finance company with 100 billion people, in the United States, 100 million people in the United States, let me know. So Robinhood announced these Q2 earnings yesterday after the bell, as is the case with earnings reports. And this was their first quarterly earnings report as a public company. I talked about the S1 and their IPO on previous episodes, but before we get into the earnings, let's quickly recap what a crazy ride it's been actually in the short period of time since Robinhood went public. As you know, they let their own users have access to, their members have access to their IPO shares, which was very cool. And that's a trend I hope to see more companies do, whether it's Spotify going public or imagine Netflix when they went public, giving shares to their subscribers or giving first access to those shares to the subscribers. Really cool idea. The IPO went out at $38 a share in late July. And it was a pretty wild ride. I don't really care about the stock price in the short term, just to be clear. A lot of people have been asking me to comment on that. They've been trying to have me on CNBC to comment on it. If you're holding a share in a company for a decade, you really don't care about the day-to-day stock price. You're just concerned about the growth of the core product, profitability, the management team, and that kind of stuff, which is all excellent. So on the first day of trading, it went down 10%. And oh my God, everybody is such a failure. This is so terrible. This company is horrible. And I just look at it going like, that's not the number to watch. Like, how many accounts do they have and how many assets do they have under management there? 4 days after going public, something happened where it rocketed up to $70 a share. And then my phone is going off the hook. Hey, will you come on CNBC or my podcast or friends of mine or LPs? Oh my God, it's $70 a share. So you get the highs, you get the lows as an investor. And I try to even that out. And I just try to think in decades if I like the company. So now it's been around like that $50 a share price from what I understand. I don't check it incessantly. And today it dropped to 45, and that represents a $42 billion market cap, which seems like, for me, pretty fair market capitalization. Some people might argue it's high. Some people might argue, this is going to be $1 trillion company, so you have to get in now. It seems reasonable to me. But what do I know? I'm an early stage investor. So let's talk about the Q2 breakdown. They had revenue of $565 million, which is up 131% year over year. Q2 revenue from crypto trading alone was $233 million, which is up, wait for it, 46x year over year from 5 million in Q2 of 2020 when they started. So this is super interesting. Obviously, crypto is a major space. So what's happening here? I have a thesis. You tell me if you think it's right or wrong. I think people are fleeing from the rogue exchanges out there in the world, and they would like to be with US-based companies that they can trust. So again, you have all these fugazi, weird, offshore, questionable places you can trade crypto. Wouldn't you rather be on Coinbase or Robinhood and have that security of a publicly traded US company? I think you would. And so it might not be that there's so many more people interested in crypto. I'm sure there are people who are interested in crypto, but it might be people saying, you know what? I want to trade crypto on Robinhood, not on, some offshore or no shore or floating place, for trading cryptocurrency. So over 60% of cumulative net funded accounts traded crypto in Q2. Over 60% of cumulative net funded accounts traded crypto in Q2. So funded accounts and cumulative. So all of their accounts. So that means this is becoming a real thing. So if there were 22.5 million cumulative accounts and 60% of them were in fact trading crypto, that means they have 6 million plus 6 million is 12 million. And then, a little bit over 12 million people on the platform trading crypto already. That alone is notable. And they first introduced crypto trading in 2018. Robinhood's 2021 first half revenue was $1 billion, over $1 billion, which is up almost 3x year over year. So that is a high growth company. When you see companies growing 10, 20, 30% year over year, you start getting past 20 or 30%, you're in, hey, this is pretty fast growing, pretty great. Tripling is like a whole different level, a whole different ball game. So here's the key. Robinhood warned investors that their Q3 results may be negatively impacted by a trading slowdown. In other words, in the summer, people might not be trading as much. And this was supposed to be the end of the lockdowns. So July, August, September is Q3. Maybe people are trading less because they're going out more. And then you have the Delta variant. So who knows? This could be headwinds. This could be tailwinds. These are choppy waters. Obviously, the pandemic ending and then Delta beginning really means nobody knows exactly what's going to happen, except that I'm at peace with it because we've seen what a lockdown does and society can survive a lockdown. And if we go back and we see what the vaccine can do and how quickly they made it, they can make another vaccine. So I believe that we can get through COVID, whether it's here for 10 years or 2. I hope it's here for 2, and I hope we get past this and people get their vaccines because we could squash it and there won't be more variants. So please, if you're listening to me, consider doing some research on the vaccine. If you're hesitant, just do some research, make your own decision, talk to a doctor, look online, maybe look at the statistics yourself and think for yourself. I'm not going to tell you to get it or not get it. I mean, if you were my friend, I would tell you, yeah, absolutely get it, save your life. But I understand that the people who haven't gotten the vaccine by this time are likely to have some strong feelings about it. So I'm not going to pile on here and tell you you're an idiot or you're stupid. You probably have some reasons that you feel strong conviction about. Maybe talk to those with doctors because maybe you had those strong convictions before we broke 1 billion people, right? And maybe those strong convictions, maybe you would change your decision in light of new information. And part of that new information might be just looking at who's in the hospital and who's dying. It really is a pandemic now of the unvaccinated, and you're going to have to make that risk assessment for yourself. I made the risk assessment for myself. I understand you might make a different one. So that's just a little PSA here to people who are either anti-vax or concerned about vax. I'm not going to insult you and call you an idiot or stupid. I'm going to just ask you to look at the new information that's in front of you. Let's get back to Robinhood. So there are really 2 numbers that I think matter in these businesses. The assets under custody, AUC. So no matter which financial services group we're looking at, I think that's a key statistic. Why is that important? Well, you could have a lot of, accounts that have $100 in them. That may not be as powerful as having a smaller number of accounts with a larger amount of money in it. This is fairly obvious, right? Assets under custody, AUC, grew over 3x to $102 billion in Q2 2021, compared with $33 billion in the second quarter of 2020. So let's take a pause there. That is serious growth. $33 billion And then we're here a year later, 102 billion. Will we be here next year saying 300 billion in assets under management, and then 900 billion, and then 2.7 billion? Actually trillion, right? So we'd be at $2.7 trillion under management. Robinhood ended the quarter with 22.5 million net cumulative funded accounts, which is 130% year over year growth. To put that in perspective, as of December 31st, 2020, they had 12.5 million funded accounts, which is almost doubled in 6 months to 22.5 million. And if you go back even further, when I had Vlad on episode 736 of This Week in Startups, that was back in 2017. Robinhood only had 2 million total accounts. And there is, a very interesting moment. As I go into my second decade of investing, I'm now learning about being a shareholder of the companies I invested in before they had their products launched as public companies. And one of the things I did when investing in companies and even building my own companies, I envisioned a world where the product was 10 times bigger and the customer base was 10 times bigger. Then I envisioned 10 times more revenue and customers, and then 10 times more, and then 10 times more. So I would do this little powers of 10 exercise in my mind. And when I met Robinhood, they had 0. And when they had 100,000, it's like, oh, what if they have 1 million? When they have 1 million, oh, what if they have 10 million? When they have 10 million, now I'm thinking, hey, what if they have 100 million? Which is what I just said to you earlier. It's very easy for journalists who, tend to be a little bit negative on financial companies and tech companies right now because of the power they've accumulated. We'll put that aside. I talked about it, I think yesterday in relation to Superhuman. Pausing for a second. Do you think a company that 10x from 100,000 to 1 million, then 10x from 1 million to 100 from 1 million to 10 million, and then doubled to 22 million in 6 months, do you think they're not going to get to 100 million? I had these discussions on CNBC over and over and over again with the naysayers about Netflix and then Disney Plus. And you look at those services. I believe we're moving to a world in which these global brands, and I do believe they're going to be global, will have billions of users. We saw it with free services like Facebook, Instagram, WhatsApp, Chrome, Google Search. Very few brands actually have 1 billion plus users. We can actually almost count them on 2 hands. Yeah, let's do that right now. Google Search. I think Gmail is over 1 billion. Chrome, Android, iOS, Facebook, WhatsApp, Instagram. I believe Instagram's over 1 billion. I'm not counting the Chinese-based companies. So there's 8 products from, a handful of companies that have over 1 billion. Is it possible that Netflix, a paid service, will get to 1 billion? It is possible. Why wouldn't it be possible? If there's over 7 billion people on the planet, 1 in 7 seems quite reasonable. Now, you have to have a bit of an imagination here. You have to be able to think globally. You have to be able to have seen what I saw in my career, which is when I came into the industry, there were 0 users using web browsers. There wasn't a web browser. Mark hadn't created Netscape yet, and Mosaic hadn't been created. So you need to look at the arc of history. It's pretty clear to me, 10x, maybe even 100x is a possibility for companies like Robinhood, Airbnb, Uber, go right down the line, because we saw it happen with the previous generation of outliers, Google, Amazon, and Facebook. Right now, LinkedIn is going to give you a $100 credit towards your first ad campaign. I'm telling you, the call to action up front, so good. LinkedIn.com/thisweekinstartups to get that $100 credit towards your first ad campaign. If you want to get a group of people who are receptive and who are doing business, they're doing business on LinkedIn, right? When you market on LinkedIn, your message reaches people who are ready to engage with your business. This means your ad campaign will work as hard as it can as soon as you launch it. Need more evidence to use LinkedIn marketing? Well, over 78% of B2B marketers rate LinkedIn as the most effective social media platform for reaching objectives. Because there are over 62 million decision makers on LinkedIn. You know that, and they mean business. LinkedIn equals business, business equals LinkedIn. It's that simple, folks. And here's how LinkedIn marketing stands out. They have the tools for brand building or lead generation. You can pick. You can target professionals down to their job title, company name, and location. And you can engage folks you already know based on previous site visits or outreach, right? So you can do that retargeting thing. So do business where business is done. Get a $100 ad credit right now. Go to linkedin.com/thisweekinstartups once again for a $100. LinkedIn.com/thisweekinstartups. No spaces, no dashes. LinkedIn.com/thisweekinstartups. Terms and conditions apply because they're giving you a $100. So here is another interesting piece of information from the earnings report. And it's a quote: "A funded account is a Robinhood account into which the account user makes an initial deposit or money transfer of any amount during the relevant period, which account is designed to provide a customer with access to any and all the products offered on our platform." So what I like about this is it seems to me, and I don't have inside information. I was a seed investor. I put a small amount of money into the company that became a large amount of money. Thankfully, it's good to get a win. It takes a lot of pressure off, I'll be honest, as an investor, because man, being an angel investor can be super humbling. I mean, everybody knows my wins, but you don't see all the losses. Every Robinhood equals 85 zeros and 14, 1 to 50 X's. So it's nice to see that I believe here is my interpretation of it, reading it, and you can correct me if I'm wrong on email, or you can DM me on Twitter or Instagram. Feels to me like they're trying to be very intellectually honest about what's an account, which is great. There are some folks, like I think we discussed this with Nextdoor, who considered a user anybody who opened an email. I felt that was like, I'm not going to say unethical. I felt that was, maybe bending the truth a little bit. If I get an email from, the Gap, I don't shop at the Gap, but if I get an email from, whatever company, I don't want that to be counted as a user. So always be very questioning when you look at these definitions if you're a public market investor. Okay, quick story here. I've talked about for a long time that Amazon is going to open stores, and they did, sort of the quick checkouts. But there's something happening here that is much deeper. Today, the Wall Street Journal reported that Amazon is planning on opening department store style physical locations in the US. That's right, department stores. The news came as Amazon passed Walmart as the world's largest retail seller outside of China. And that was just reported in the New York Times this week. The latest information from eMarketer, which doesn't do their own research, I think they accumulate other people's, so we'll have to see who the source of this is, shows that Amazon will account for 41.4% of all U.S. e-commerce sales in 2021, whereas Walmart will account for only 7.2%. And it says here in their notes, we're going to have to check on the eMarketer research, because my understanding you can leave this in the program, we should always be careful with eMarketer because they were using other people's information, but maybe this is their proprietary information. So we want to make sure we give proper credit. Leave that in the show. I want you to know how the sausage is made here. So the Wall Street Journal notes, people familiar with the matter, in quotes, believe Amazon is expanding into physical locations to help grow sales in areas like apparel, home items, electronics, and other similar areas. Kind of makes sense, right? If you're going to do something like this, clothes are something that, it's one of the final things people like to go to stores for, and home items too, right? So it's a great move by Amazon, I think, because brick and mortar could not possibly be more compromised during the pandemic. They're probably buying up spaces for pennies on the dollar. There is a very simple way to look at this. If Amazon was challenging Walmart, but with a different product, and then Walmart added Amazon's product, that is a competitive threat to Amazon, because then Walmart can do things Amazon can't do. What Walmart can do is what's called bricks and clicks. You may have been experiencing this. I went to the Everlane store. Now, I haven't shopped at Everlane in a long time, but I needed a white belt, and I was trying to find a white pair of sneakers. Happened to walk by one on South Congress when I was in Austin for a wedding. I was like, oh, there's an Everlane store. And then the next one was Lululemon, and the next one was some other online store. I can't remember the name of it. But I think Lululemon, I'm not sure if they started as a retail brand, but there were a number of brands on South Congress that were online brands that now had opened up retail stores. They asked me for my email, and those purchases were synced with my online account. Now, if I were to buy this shirt, and know it's a size, 3 or whatever, or 9.5 in shoes, now I know that for that brand, I'm going to be able to match that size. Same account I can order with at home. And all of my billing and my ordering and my returns can happen however I like them to. If I'm at a wedding and I need to pick something up today, I can go to the store, use my same account. If I go home and I love the shoes and I want to buy 2 more pairs in different colors, same size, same account, log in, order them. I forgot which shoe it was. I forgot the model. Boom, I can do that. And Nike is amazing and wonderful for online ordering. So is Paige and Vince. Those are 2 other male brands that have men's clothing that I like. Paige, Paige. I think they started in women's. And then there's one called Vince, Vince. They make great t-shirts. So shout out to those folks for stuff I like. So Wall Street reported the size of Amazon's department stores will be smaller than ones we see from Nordstrom and Bloomingdale's. Those are about 100,000 square feet. Amazon scaled down approach, 30,000 square feet, according to the story. By the way, Amazon already has 600 retail locations. That's because they bought Whole Foods and they have 506 Whole Food locations. If they don't do what Walmart's doing, Walmart gets an advantage and Amazon does not want them to have an advantage. So they also did this pilot program of the 17 Amazon Fresh grocery stores. They've got 22 of these Amazon Go stores, based on our quick research here. Those are the cashier-less ones they've been testing. And then I've been in one of these. They have these 4-star stores. I think I was one in LA with 5 more coming soon. These are 4,000 square feet. They're kind of tweeners. And that feels like the size of like a lot of local towns where you have a main street. It feels like a main street store. And they basically have toys and books and home goods, devices. It's great for them to sell their hardware prices like Echo or their Kindles and that kind of stuff. But it's a really nice experience because they've kind of skimmed the cream and it's a nice browsing experience. And I guess they have 20 US bookstores. So I'm thinking Amazon Basics, Amazon Essentials will all be in these stores. And when they go to break up Amazon, now Amazon can just point and say, listen, Walmart's doing what we're doing. Walmart doesn't allow third-party sellers. We do. Maybe you got to break up Walmart, right? It's basically checkmate. The only thing that really, the FTC and the government, Department of Justice, whoever winds up going after Amazon to break them up, the only real case they're going to have is Amazon Web Services versus, Amazon, the retailer. And so I think it would be logical for them to break those 2 up because it will unlock more shareholder value. So 2 really interesting stories today. And now let's get on to our amazing interview. Twilio is the cloud communication platform used by Uber, Airbnb, Shopify, and many others. Not that you need any more names. I mean, think about that. Uber, Airbnb, Shopify. It's basically as good as it gets. You may have heard of them in the news back in November of 2020 when they announced their $3.2 billion acquisition of Segment, one of the world's leading customer data platforms. Everybody knows Segment if you're in the industry. Well, Twilio provides you the building blocks to add messaging, voice, and video in your web and mobile applications. They are rooted in startup culture and they are here to help you on that journey. Twilio gives you the power to build communication apps easily so you can spend more time focusing on what counts, your customers. Engage and delight your users while scaling globally, all from one API-powered platform. From SMS to voice to WhatsApp to email, thanks to that SendGrid acquisition. And founder CEO Jeff Lawson has been on this program multiple times. I think the last time was episode 967 back in 2019. Let's book him again. And here's what you're going to get from Twilio's startup program. Access to webinars made exclusively for startups and full support via the Twilio Startups team. A $500 getting started credit and $3,000 in SendGrid credits. Sign up now, twiliostartups.com/twist. Twilio, Twilio, startups.com/twist. So go get the bag right now. $3,500 in credits are waiting there for you to just take them. Twiliostartups.com/twist. All right, next up on the program is 5-time show guest, friend of the pod, Mark Suster is back with us for his 6th appearance. Mark and I have been friends forever, literally. He was on episode 25 in November of 2009, episode 279 in 2012, 429 in 2014, episode 674 in September of 2016, episode 1121 in October of 2020. And we've decided that he is in the rarefied air of being so good on the pod. I learned so much. We have such a great conversation that he's just a yearly guest going forward, Mark. I've decided with the pod, I'm 5 days a week now, 4 or 5 days a week. It's no longer This Week in Startups. It's like Today in Startups. I'm literally doing this show every day now because we sold the ads out. You remember when I started.
So I have to tell you that I was thinking about this, Jason, and I think it's an incredibly smart strategy. And I don't mean in terms of a media business or in terms of, building an audience, but I was thinking about you and Donald Trump.
Oh,
and I know I shouldn't invoke you and Donald Trump in the same sentence, but let me talk about one thing I think Donald Trump really did well and learned from, which is speaking at audiences. And he was in front of crowds, in front of big crowds all the time. And he would try out lines, and then he would get a sense of what the audience thought and how they reacted and what they cared about from their reactions. So I thought, I was thinking about this. I went running this morning and I was thinking, what do I think Jason is uniquely good at? And you, by doing this show, have stayed really close to the zeitgeist of both what entrepreneurs care about and what your audience cares about. And I thought a better metaphor than Donald Trump would be Steve Martin or Chris Rock. Because it's the same thing. You don't go straight and have a great comedy show. Like you're performing, people are laughing, they're not laughing. They like this bit, you try out that bit. But you just get much better. And I think the same is true, not just with your show, but really about what makes you unique as an investor, because you have your fingers on the zeitgeist. And I remember when I did your show This Week in Venture Capital a decade ago.
Yes, I forgot about that.
It was great for me, Jason, because I just constantly felt in the zeitgeist of the conversations, and I miss doing it.
Okay, we'll start it back up then. Okay,
there you go.
You just committed. We'll start the show up again. I mean, it's a joke, but it's possible. I have to say, and thank you for the kind words. It has been the great joy of my life doing this podcast. And I agree, the zeitgeist is the reason I do it. Instead of going to lunch with people, I substituted this, right? And I would just take out one lunch a week and do This Week in Startups. And then it became 2 and then 3. And now we're basically doing 4 or 5. I mean, the ads are sold out till November. And now my team is like, hey, what about a Sunday show? And I'm like, yeah, sure. We could do a Sunday show. Let's come up with an idea. And it's so much easier to do, Mark, now because of COVID. Everybody like yourself has a quality setup at home. And Zoom has gotten so good. And the microphones have gotten so good. And people know how to plug in an Ethernet cable. And people also know how to talk virtually. And they're more comfortable having a conversation like this. I used to do a GoToMeeting or, a Skype call. And 9 times out of 10, we'd have to cancel the show because they couldn't get it up and running. Now it's like, this is my 5th call of the day. I know how to do it, J. Cal. We're good. Reflecting back to you, something I took from you as a friend is years ago, you wrote a blog post, and I remember Fred Wilson had written one before you about your yearly trips and how you looked at how long you had left with your sons. You have 2 kids, I believe.
2 boys, yeah.
2 boys, and your sons were getting older. I think they were 10 and 11 at the time you may have written this. And you said, hey, I got 6 left with one. I got 5 left with another. And then they're off to school. Got to make every summer count. Well, here I am. I'm in Italy. I did a 2-week trip with my kids last year or 2 years ago before COVID. We had done Australia. And I'm just looking at this with my 11-year-old going, okay, 11, 12, 13, 14, 15, 16. I got 6. And with the 5 years old, I obviously got a little bit more. I actually sent them home because they had to start school. And my wife was like, you should stay a week and do that book thing. And I was like, wow, I got the greatest wife ever. So thanks to my wife. But I'm here still I'm at a secluded beach town in Italy. I won't say which one, writing my next book. And
awesome.
It's been great. So let me start the conversation with you and I have lived through the start of a super cycle, 2009, when I became a Sequoia Scout. UpFront Ventures at the time was called
GRP.
Yes. I think you were a couple of years into the job. You had been an entrepreneur before that.
Yep.
And you and I were investing in companies for 4 or 5 million. And if there was the term unicorn did not exist, the iPhone was a very new device, it was on the second version perhaps. And now here we are. It's 2021. It's about 13 years later, maybe give or take, 12, 13 years later. What do you make of what we're seeing in terms of the outcomes for the companies we invested in back then at the start of the super cycle? I'll call it a super cycle, for lack of a better term.
Sure.
And is this sustainable? And does it make you nervous? What do you think about this? Because you sold Maker for $1 billion. That seemed crazy at the time. Now it seems like, oh, probably sold too early.
Yeah, now we have GOAT, Sneakerhead Marketplace.
Yep.
We were the earliest institutional investor there. It's publicly released knowledge that it's worth $3.7 billion. And
Crazy.
But what's crazier is the volume of business that they do. It was staggering. I know in the earliest days, Eddie and Daishin and the board member from UpFront, who was a large part of why GOAT was successful in the early days, Greg Bettinelli, the biggest resistance they got from investors was how big of a market could this really be? There was a quote unquote TAM problem, total addressable market problem. And I think that's the thing, the imagination of so many investors, which is that things are niches. I remember years ago looking at a business called Crunchyroll.
Yes.
And Crunchyroll, it was a Japanese media company. And
it's like a Netflix, right? If I were to describe it as like Netflix of Japanese content and Asian content.
Yeah, and what it was particularly good at was taking what you and I might consider a niche, let's say like anime, and it was making it available to international audiences, and particularly in the US. And it turns out that in the world of the internet, what we have is scale. And what we thought of as a niche, like if I launched a store 100 years ago in Minneapolis and I launched an anime store, I'm not going to have that many customers. There aren't that many. There's not enough anime fans in Minneapolis. I picked one city to build a real big business. But in the world of the internet, with increasingly 4 billion people connected to this global network, the communities are really large. And so that was just an example of something where GOAT was a TAM that people didn't think was huge. They're selling literally billions of dollars of sneakers.
Amazing.
Billions with a B. Then you look at, I'll tell you another weird one. Hopefully this helps people think about how markets and communities form. We looked at another one called Viki, V-I-K-I. It stood for Video Wiki. It was created in South Korea. And what they were doing was they were taking South Korean dramas and bringing them to the United States and other markets. And because they were in Korean and most non-Korean speakers therefore couldn't have access, they would launch competitions. And the competition was how quickly could the audience transcribe it into different languages. And the faster you did it and the higher quality, the more awards and points and little stickers you got. And so they got these free groups of transcribers. So think of it like Wikipedia, Wiki, Video Wiki, Viki. And it turns out there was this show, I just remember it from 10 years ago, called Boys with Flowers. It was a South Korean drama. But there was a huge audience in the US of non-Korean, mostly white people who like to watch it. And if you could globalize that, that's a big business.
It is amazing, this observation. And also coming from a Korean family, my wife is 100% Korean. One of my sister-in-laws, one of her sisters said, Jason, be careful. Koreans are the Italians of Asia. They have the most passion, and there is a reason why everybody in Asia and outside of Asia now increasingly are watching South Korean dramas, because they are they have the most, let's just say, vibrance and enthusiasm for relationships. And it is kind of like Game of Thrones. Their soap operas are like Game of Thrones combined with a soap opera. But this is a very interesting point. We have an investment in a company called Soul Savvy, which is also in the sneaker space. They recently had a very high valuation. They are printing money just in essentially having a community of sneakerheads talking and discussing what's for sale on GOAT and whatever the other one is. There's another marketplace. StockX. And so they're sitting on there paying for monthly subscriptions to discuss sneakers. And you're exactly right. What we've seen over the past decade is, as the tools went to scale, people realized like one little niche could sustain it. I couldn't get anybody to invest in Calm. And Alex and Michael told me after I did the seed round, we were going to shut the company down. I said, I actually didn't know that. That's good information. Thank God you didn't tell me at the time, because I might not have made the investment. He said, literally 50 investors said no, you were the 51st. I was like, well, that's a pretty great feeling.
Jason, tell me the name of the sneakerhead company.
It's called Soul Savvy, SOLESAVY.
Soul Savvy. So let me say this, because I want to use this as an example of what I think of the most important defensible strategy on the internet is. When I work with our portfolio companies, I often am saying this, which is the only truly defensible strategy in my mind is community.
Wow.
And that's why marketplaces can be so big and so successful. And I want to give you a couple of examples. But the reason I want to tell you first, which is if you launch a widget, let's say a hardware product that you're selling, I don't know, I see, it looks like you have an Apple Watch there. You launch a watch and you want to be better than other people. You might be first to market. You might be first to the market with Ring doorbell. We were the first, big institutional investor there. But in the end, you're never going to have better purchasing power, more engineers, more leverage, more ability to sustain losses than Amazon, Google, Apple, everybody at scale.
Yeah.
And so long term, it's really hard to form differentiation when you're in a valuable market, except if you have community. Because if you are the place where everybody goes, it's really hard to get all those people to migrate en masse somewhere else. So the example I would give you from Ring, the brilliant move that Jamie and his team made, also a guy named Mark Troughton, made, was to create these Ring networks. So think of it as neighborhood watch. So everyone in your community could opt in. You don't have to be part of it, but if you opt in, you can see other crime happening in your neighborhood.
You can see each other's doorbells, or you could see clips.
You can choose to publish into the neighborhood watch an event. You don't auto-publish everything. You can publish an event. Let's say that someone came and stole your Amazon package. Let's say that someone broke into your car and you have that video. You can publish that event so your neighbors are alerted to, if you see this person near your house, be aware they broke into my car yesterday, right? And I know there's some controversy that people find over that, but I find it to be a modern version of neighborhood watch. And I think it's highly productive, with controls. But let me say this, Jason, which is now you take a local area, let's say wherever you live, and if you can now go to Best Buy or Amazon and buy a product for 30% cheaper, are you going to? Or 12 new features, are you going to buy that? Or are you going to buy the thing that everyone in your neighborhood's already using because that's the place you share? So that is the most important part, I think, of sustainable differentiation and defensibility communities.
I've never heard anybody say it that way. I think it's a very profound insight as well. Listen, as a founder, sometimes finishing a project is way, way, way harder than starting it. Starting is easy, finishing is hard. Shiny new ideas are great. You have them all the time. And sometimes you and your team don't have enough bandwidth to finish the mission. And that's where Fiverr comes in. They fix the issue by creating Fiverr Business. Fiverr. Fiverr Business will get you access to an all-star team of freelancers, plus all the tools and support you need to easily integrate them into your existing workflow. There's no more guessing. There's no more interviews. Fiverr's team of dedicated business success managers will help match you with the best talent for your team. In other words, they got a manager of the talent over there doing what I was doing. How brilliant is that? And you will be able to save and share your favorite freelancers for future projects all in one simple dashboard. We love it here. We've hired a bunch of researchers to find local people to invite to our event. Boom, Fiverr got it done for us. They deliver us the goods. The event was a success. Stop wasting time searching for talent and just leave it to Fiverr Business. They do a great job. Right now, you can sign up for free. That's right, free for the first year. And you save 10% on your purchases of Fiverr Business with the promo code Jason. That's right. The promo code is Jason. Just go to fiverr.com/business and use the promo code Jason to get 10% off. Fiverr.com/business. Let's just tackle this head on. The only people who wouldn't want to stop criminals and would have a problem with what Ring is doing is virtue signaling dip on Twitter. I'm going to say it. You don't have to say it because I know you're connected to Ring and we both know Jamie Siminoff. Who doesn't want to stop Amazon packages from being bought? And if you're saying the issue is privacy, there is no expectation of privacy on public streets. You cannot have an expectation of privacy on my porch or on a public street. You're in public. That's why it's in public.
The
It's crazy that people have, I mean, it's mind-bogglingly stupid that we give so much attention, the press and social media, to these people complaining about stopping crime.
So the preponderance of benefit is overwhelmingly with the community that benefits from crime reduction. Every great invention has negative externalities. And I think it's okay as a society to acknowledge those. I'll give you examples of a negative externality of something like ring existing. Racial profiling.
Sure.
You know, if everyone starts saying, hey, I saw a black guy in my neighborhood, and that becomes shorthand for, hey, that must be a criminal, that's not good, right? So
Sure.
I think it's good for us to have our ears attuned to the downside. I think it's good for us to have our ears attuned to, could someone, a company, I trust Amazon, but could a company like Amazon over time use cameras, use devices in our house to listen, spy, have surveillance? Could the government use this as a way to then surveil audiences like the Chinese with the Uyghurs and, you know, whatnot? So I think we need to have our antenna attuned to it. So leave aside virtue signaling. I'm okay with the super left wanting to challenge the societal negative externalities of this, even though for the most part, I don't agree with them, because I think it just keeps us honest about the things that could go wrong and forces us to be more thoughtful about it.
That is certainly something to highlight. For example, I recently had a company that scans license plates for communities. And it turns out when they put a license plate scanner in, crime plummets. The same way when Ring doorbells hit a certain critical mass, crime plummets in a neighborhood. Would you rather, to your point, at the end of the day, would you rather have lawlessness or more police, or would you rather decrease crime by having the presence of cameras? Well, if it's on the street and everybody's got a camera in their pocket, that cat's out of the bag. Everything's being recorded.
The cat's out of the bag is a good way of phrasing it, because we are going to have cameras. We are going to have other devices. We're going to have microphones. We're going to continue to have technology. So we need to just continue to have the debate about what are the boundaries. But I tend to overwhelmingly side with using these tools for safety and security, and just being attuned to the negative externalities.
I challenged the founder of this company with the license plate over and over again about, like, hey, where's the downside? And I was like, hey, what if somebody, flock safety, Garrett Langley, episode 1249, for those of you who might be interested in watching it. And I was like, so can, I get into this flock database and search it and, I don't know, stalk an ex or spy on my neighbor? And I was like, no, the police have it. They have 30 days. The largest, they can set it, but the most anybody's ever set it to is 90 days. And then, they can save a license plate if it's been involved in a crime, but we don't actually take a picture of the person in the car. We just send the license plate. This license plate has a warrant associated with it or whatever. And they say, we saw this license plate in this neighborhood. They give it to the cops. And they said specifically we didn't put the picture of the people in the car because we didn't want to have any racial profiling issues. I was like, wow, that is incredibly thoughtful. I said, what happens to the data after 30 days? They're like, it's destroyed forever. And I was like, well, that is also very thoughtful. So to your point, you could have the debate and then find a thoughtful answer. Of course, that seems to have been lost, in the Trump era of extremes.
Let me slight pivot on our conversation, because I could spend the whole thing talking about security and other stuff that we look at and are aware of, that some of which is scary. But you asked about the megatrend of, say, 2009 to today. And one thing I might talk about is what I think it means for venture capital.
Yes. Changed dramatically.
It has changed dramatically. And I want to talk about it in terms of how it's changing UpFront Ventures. So my own firm. Sure. And I think that venture capitalists historically didn't change that much. They like to kind of keep things how it was. And, there wasn't a lot of innovation. But right now, we know that with capital markets changing so much, we have to innovate. We have to constantly evolve. And I think the best observation about venture capital came to me about 8 years ago from Scott Cooper at Andreessen Horowitz. I think he's one of the best thinkers about the market. He's written a book I won't Google it right now. I can't remember the name of it, but he's written a book about the venture capital industry. It's very good. People should read it. And he said to me at a conference, he said, the industry is going to bifurcate. You're going to end up with the mega VCs. Let's call them the Goldman Sachs of venture capital or the BlackRock of venture capital. And then on the other end, you're going to end up with niche and little small people who own some neighborhood, whether it's video or payments or physical security, cybersecurity, physical products, whatever. And people in the middle are going to kind of get caught. And he was just pointing to, for example, the investment banking world, where that exactly happened. And I didn't really believe him 8 years ago, but I love when smart people challenge me with ideas. So I always kind of held that idea in my mind. And it's pretty obvious to me he was right now. And I've seen it now for a few years, but
how does it manifest for people who don't know?
Yeah.
The entrant of Tiger and some of these later stage funds, and then the ascension of Sequoia having many funds, Andreessen having many funds, and the size and the scale of those funds. How does that manifest it for a firm like yours that does Series A as its bread and butter?
Well, in 2009, which is where you started the conversation, I could wait and get a whole bunch of data on how a founder was doing, how their customers were doing, were there repeat purchases, were they expanding sales, were they winning or losing deals? And I could track it for 3 to 6 months. And if it was trending well, I could write a $3 million check for, whatever, call it
20%,
17 to 22%, depending on competition and how well they were doing. I could take my time. And that was considered an A round. And I would take a board seat and I would be active and I would work with them on building the executive team and product strategy and pricing, and then help them raise their $15 million round, which was a B round. Well, now seed rounds are $3 million. Some seed rounds are $5 million. A rounds are kind of $15 million. Some are $20 million.
Crazy.
In 2009, you would fund deals at a 7-8 pre. Now, that same deal's probably 25 pre, 30 pre. So it's changed a lot. So if you want to be an A round investor in how the market defines it today, you've got to be writing $10, $15 million checks out of the gate. And you've got to be paying 40 pre or higher. The good news is that back then, $1 billion outcomes were rare. Now there's
so rare we didn't even have a term for it.
Yeah. And Aileen Lee coined the term unicorn. Unicorn being something so rare that it doesn't really exist. Now it's kind of a funny term for it that everyone uses and doesn't stop to think, why do we call it unicorns? Thank you, Aileen Lee. But now $10 billion is not crazy. If you look at Okta, look at Twilio, look at $50 billion and up companies that, every day I could call my family members. They've never heard of Okta or Twilio, right? And so we're creating these tens of billions of dollars of outcomes. So companies are able to pay 40, 50, 60 pre, build a portfolio as long as some of their companies become worth $5 billion and up. Now, I've decided that we UpFront Ventures are not going to chase that market. Because that market is, I think, for people who want to raise $1 billion funds. So what I'm doing instead is exactly what we've been doing for 25 years. We still want to be your first institutional capital partner. We still want to take board seats. We still want to help you with the hard work of the early days of a company. But I have to be willing to take an earlier risk. I can't get all the signals from your customers. So I have to be better at talent scouting, better at knowing who's coming to market, better at kind of persuading you to leave your job, better at understanding founder market fit, not product market fit. And I got to take an earlier bet, but I'm still writing a $3.5 million check. I'm just committing earlier. And then I'm helping you go raise $20 million behind me. And we've been very successful at that. So I think we are largely becoming a seed fund, UpFront Ventures.
That's incredible. We're in the same business.
But I think of you now kind of more as a pre-seed or super angel, in a way. It's just that the markets have changed and become more micro-focused. But the one thing I want to differentiate between UpFront and maybe a traditional seed fund is we are seed/A. And what I mean is I'll write the $3.5 million check. By the way, that's the amount I wrote into Density, one of the companies you and I are on the board together with.
Yeah, I did the seed, you did the Series A.
When now we would call it a seed, right?
Well, think about it. I put in $400K when it was a $5 million company. You put in $3 million when it was a $10 or $15 million company.
11 pre, I think.
11 pre. So now you look at that relationship. I am actually doing what you did, but I'm still referred to as an angel or seed investor. I'm a unique, weird bird, but you're basically dipping down and saying, you know what? I would take it at the stage Jason made the bet, pre-product market fit, less customers, less, proven, but pay the higher price and then act like a VC. Yes. So bring that level of professionalism and board structure and growth and tee it up for the Series A.
So when I say seed/A, I wrote $3.5 million in that round, but when Founders Fund came in behind us and wrote a big check, I wrote another $4 million check.
Yes.
So instead of writing 3.5 and tapping out, I write 3.5 and then 4. And by the way, then when they weren't ready for a B round, you'll remember this, I wrote a $4 million check when no one else would.
I remember that. Yeah, it was big time.
And then suddenly we got this really great investor, Kleiner Perkins, came in with a really big check. And Kleiner, I think, really plays the traditional A round, what now is an A round, because they don't mind writing a 15 to 20 million.
Let's call it the new A for this conversation. The new A. Right? The new A.
Now, here's the other thing about that sat with me from Scott Cooper, which is I then went out and raised 3 growth funds. So I have a barbell strategy. I want to be seed and late stage, but I don't want to compete in A and B. And so here's what I've done with my growth funds is I can put $50 million into a deal. I have several deals where we are tens of millions of dollars in, and this won't be a surprise to you. It's Goat, Appeal, Bird, companies like ThreadUp, FabFitFun. It's like these companies that have become major winners that I can then move a lot of money into.
And
Appeal Sciences.
Would that $50 million represent from your growth fund pro rata or like super pro rata if we were to look at it? Because you own 13%, say you own 12% of a company. Now they're raising at $2 billion. $50 million is but, 2.5%. So is it like keeping up with your pro rata, or does it sometimes make it super pro rata? How do you think about that?
It's often less than pro rata, if you can believe that.
It's crazy.
Yeah, it's often less than pro rata. So let me define for you my strategy, just in case anyone else is wondering, about evolving their own strategies, investors, that is. Our A fund, our seed/A fund, we aspire to get $10 million in before our growth will participate. So we don't want the seed fund LPs to feel like they're being crowded out by this other money. Okay.
Right.
So we aspire to get $10 million in. I actually have to get approval if I'm going to do less than 10 million before my growth fund comes in.
What's the size of that? Well, what's the size of that fund? The A fund or the seed fund?
They kind of
300 million.
Yes.
Got it.
Around 300 million. So some have been 280, some have been 380.
How many names in that fund? How many unique names do you think?
In terms of portfolio?
Yeah. How many companies would be in
38 per fund.
Got it. Perfect.
38 per fund. And we really religiously try to target getting 38. I think that's the right amount of distribution for us in terms of risk. And then the growth fund does not lead rounds. It does not price rounds. So what we're aspiring to do is write $15 to $20 million checks on average. I can write more, as I've already identified, but 15 to 20 million on average as part of a 50 to 75 or greater $1 million round, in which there's a lead who prices, in which I still believe there's minimum 3x return from here. Usually 5x or greater is what we try to underwrite to. And there's sort of safety in numbers of the dollars, because if I'm writing 15 out of 100, they now have all the other capital, all the other participants at the table who have also priced it with the expectation of at least 3x returns. And it's later in what you call the J curve. So, the J curve of investing is you start writing a bunch of checks and you get fees. So your returns are actually negative for a period of time until your companies get marked up, at which point you have returns, at least on paper.
This is why people say the third, fourth, and fifth year of investing are particularly challenging for a venture fund or an investor because you feel like I'm a schmuck. I started with 300 million. Now my portfolio is worth 150, and you still have to wait for that maker density FabFit fund to come out, and all of a sudden now you're back above water. But it's known and it's expected.
Yes, and it's slightly a tiny bit nuanced, different than that, Jason. Which is if I committed to him, if I have a $300 million fund, again, just for listeners to learn, if I have a $300 million fund, I'm generally only investing 40% of that in first checks. Okay. So a good deal of that is reserved. But also in that $300 million fund are my fees. So I commit to investing 100% of the fund. How do you invest 100% of 300 million when some of it is fees?
30 million of its fees. So you're negative 30, right?
The way you do it is recycling. So in year 3, 4, 5, 6, when we sell companies, we take some of those dollars and instead of returning them, we reinvest them. But we reinvest them with no fees. And so
you have the ability to do that with 10% of the fund, I guess, is the typical number.
Every fund is different. We have the right to recycle up to, I believe it's 115%, to invest up to 115% without approval of the fund. Now, LPs want you to be 100% or greater. They actually want it. If you didn't recycle and continue to invest, some funds do 85% of their fund invested. And so this model of recycling and getting your dollars up is how you get 300 invested. But let's take year 1, 2, and 3. It's not that I've written off 50% of my fund. It's that I might have 100% of my fund at 1x. They haven't been marked up yet. And I might have charged $3.5 million in fees. So by default, I'm lower than 1x capital. I'm underwater.
It's and like then you as move I get into a house, you get a mortgage, you're paying interest, and then you decide to redo the kitchen.
Sure.
You're underwater. And maybe the house grows in value over the next 5 years. And then at some point, you're above water.
Yes. Now, what a lot of people don't realize in this world where we actually charge fees is we actually have to pay those fees back.
Yeah, it's not free money.
It's not free money. And I know a lot of people think it is. It's not free money. You have to pay it back. So if I have a fund that's 300 million and I return 600 million in total, let's say I did 2x gross, which is not great, but it is what it is. And so, that's 300 million in gain. 20% of that is $60 million, right? So there's good carry on that. But I got to pay back all my expenses. So let's say the expenses were 40 million over the life of the fund. Okay, well, my gain's really 20 million, not 60. And so those expenses have to be paid back. So it's a
now
false
you have
narrative.
5 partners dividing 20 instead of 5 partners dividing 60 over a 10-year period.
So keeping your fees down is not such a bad thing, keeping fees down. And,
you know what? It's very interesting you mentioned this. I have very small, my first fund was 10. I recycled one, so it was about 11. Second fund was 10. I was racing so fast with fund 10, I didn't realize I deployed all of it and I still had fees left, but I was like, okay, I'm just going to deploy it. I moved on to the next fund. I didn't take the fees because I was like, what do I need the fees for? I don't need it.
Yeah.
Because I was so capital efficient.
And by the way, then your IRRs go up.
Exactly. So I think that's, let's explain that to the audience because people love to hear about this inside baseball stuff. This is turning out to be a great episode. So your internal rate of return is the average amount you returned each year on a percentage basis.
So let me tell you the 4 measures that matter in venture. The first is called MOIC, multiple on invested capital. Some people call that gross returns. So that is, I raised a $300 million fund. I returned $600 million. That's a 2x MOIC. Okay.
Multiple on invested capital. Cash on cash, basically.
Cash on cash. Now, the thing that LPs care more about is called TVPI. Total value per invested capital. That's net of fees. Okay. So net of fees, net of carry. So that's the net return. So if an LP gives you, let's say you have a $300 million fund and their 30 million of it are 10%, and they give you $30 million, They don't care that you generated 60 million total for them in gross value. They care, well, what do I get back, right? So if they get back 45, they only had a 50% gain, not a 100% gain. So the TVPI subtracts out. Now,
and that's
funds,
true cash in, cash out for the LP.
That is exactly it.
Cash in, cash out, which is interesting. I'm an LP in a very notable fund. I won't say which one. And one of the most famous investors just said to me at some point, just don't worry about any of these numbers in the reports, Jason. How much cash did you put in? How much cash did you get back?
Yeah.
That's all that matters.
Yeah. Ultimately, that's all that matters. But there are some interim ways to judge a fund, which I'll describe. But so MOIC is gross, TVPI is net. And the thing about TVPI is that is your paper gains. That is what your companies are worth on paper. And that's what your LPs are measuring. Now, if I do a deal, let's say I do 38 deals and one suddenly gets marked up to $20 billion. Well, my TVPI might look amazing, but people need to scrutinize that and say, well, did Sequoia invest at $20 billion? Or was it a strategic or some weird investor that just paid that price and, is not necessarily a good indication of long-term value? So there's TVPI. And then there's the true measure. And the true measure is DPI. DPI stands for distribution per invested capital. That's cash in, cash out. That's your distributions. So if I have a fund that's 300 million and I have actually returned 200 million of that, well, let's say that my total amount that I got, including fees, was 300 million. My distributions of that 200 million, I have a 66% DPI. And DPI is, am I sending cash back? Or is this just you marking everything up on paper? And then the last thing is IRR. And IRR measures how fast are you sending the money back. So if I take 300 million and I return it in 1 year, say if I return 600 million in 1 year, my IRR is going to look great. If I take 300 million and I return 600 million in 20 years, my IRR is not so great. So internal rate of return is how fast do you deploy the capital? And I'll tell you one last thing that increasingly I think people are going to start measuring is called PME. And PME stands for public market equivalence. So now I say, okay, my IRRs are, let's say, 25%. That's a very good IRR.
Every year you make 25%. Amazing.
Yeah. Let's say it's 25%. So I have several funds north of 25%. I have some that are north of 40%.
Amazing.
And I have some that are less than 25%. And what I would say to you is, what investors want to know is, what if I took those dollars at every point that you invested in, instead of investing in you, I invested in the public market index? How would that have performed? And so if I write $5 million check each quarter into companies over, let's say, 12 quarters, and instead I had written that $5 million into the stock market at that time, how would that compare to your returns? So that's called PME, public market equivalence.
Fascinating.
Yeah.
Is that becoming more prevalent for folks?
No, but more sophisticated LPs and more sophisticated VCs start to think about PME. And we've always calculated that. And I find it a very helpful benchmark to judge, should you be giving me money or should you be putting your money in a NASDAQ or a S&P index?
Because we always hear the public markets have done 7% historically every year. But if we're in a super cycle and Amazon doubles in 1 year and Disney triples or doubles in every 3 years, whatever it is, well, they're getting a pretty good IRR as well. They might be having a 25%.
If you're a public market investor, you have something that you don't if you're investing in venture capital, is you have liquidity.
Yep.
You could double Amazon and take your earnings home in 1 year whenever you want.
Yeah.
Whereas in venture capital,
you could move from one to the other. You say, listen, I love Disney, but I think they hit their peak. I want to put it into Amazon now.
Last insider baseball thing for you.
Sure.
And this is something almost no VCs know, and I know that almost no LPs know. I've experienced this as I've tried to explain how the data works to people. If you have a fund, let's say, pick a year, 2015, and I deploy all my capital in 2015, and you could say, is that good or is that bad? I generally think it's bad because I think spreading your investment over multiple years gives you access to different platform changes and has more diversity built into it. It's called time diversity. And time diversity matters. If you put all your investments in 05, you missed the iPhone that came in 07. If you did all of them in 07, you probably missed the App Store, which came, 18 months later. And so if you put all your video investments in 03, you missed the changes that led to YouTube in 05, right? So
cloud storage and broadband.
And streaming technologies that came out from Adobe and other people. And so time diversity matters. So let's say you put $300 million to work in 12 months in 2015. And let's take strategy 2, $100 million in 15, $100 million in 16, $100 million in 17. Okay. Now let's say you measure in 2018 and you try to compare the TVPI or the moat of those two funds. Well, the one that deployed everything in 2015 is going to look better. You know why? Because every one of its freaking deals are 4 years old. Whereas in the more prudent strategy, 2015, 2016, 2017, the 2017 companies are only a year old. So of course they're not marked up. So you're comparing apples to oranges. And so I think the conservative, smart, distributed multi-year strategy, you have to understand the data set. So people who are a little bit more cavalier about their pace of investments actually look better and therefore can go raise funds. Now, if the markets continue up and to the right and we have no corrections, being cavalier or being really fast-paced and
some might say bold, somebody might say reckless. We'll see when the outcome happens.
I don't know if it's bold or reckless, but let's just say taking on more risk.
Yes.
And that risk is rewarded in a bull market. In a correcting market, it is massively punished. And we just haven't really had a big correction since 09.
All right. So there's a great jumping off point. Is this a bubble and where is the bubble? Right? Because when you have these bubbles, it's not always equally distributed.
So yes and no, Jason, which is
I knew would be the answer. So early stage, A, B, new A, where's the bubble here?
If it's okay with you, I'm going to take it up a level, which is a lot of people are worried about inflation right now. And I tend not to be one of them. And it depends, look, nobody really knows. No one has a crystal ball. The market's going to try to figure it out over time. And it depends which economists you follow. I think, and I think anyone, let's say right of center, will probably hate this, but I think that the economist who has been most right over the last 10 years has been the Nobel Prize winning Paul Krugman. And he has been saying for the last 10 years that people are overplaying inflation. And if you're interested in the topic of inflation and whether you have right-wing, right of center beliefs or left of center beliefs, it's worth reading him and reading his arguments. But he gives a lot of arguments on why he believes inflation right now is likely, he doesn't say absolutely, but likely to be temporary in nature. A lot of it driven by things like used cars and the massive boom in used cars prices. And so what he's saying and what makes sense to me is that we don't yet know if inflation is going to be persistent or if it's really driven by some of the things that happened to us coming out of COVID and certain materials being scarce and
supply chain issues and
chipsets in China and whatnot. But
and lumber and a small number of cars being available and everybody having stimulus checks to buy a new car. And then there being no cars available and resale prices go up. That's inflation. But when the car companies catch up and the stimmy checks run out, now you don't have demand.
So I think the one view I can tell you that I think is generally accepted is we have asset bubbles.
Yes.
And so what's happened is almost every asset class, like name an asset class that hasn't seen massive appreciation. The stock market, private markets, check. Housing markets, commodities,
triple check.
Go down the line. Crypto,
baseball cards,
crypto, collectibles. Show me somewhere that hasn't had appreciation. So people who are investors, who have assets, who have wealth, have gained dramatically. And if you don't have anything to invest, you haven't gained because wages haven't gone up. Wages going up is actually, they are starting to, but they haven't gone up at the same pace.
Right? That's a 3-month thing with this.
But it's a good thing.
I think so too. Let's jump into that after we finish up inflation.
So let's put a pin
I just say,
wages. I think government leaders have made the decision that assets appreciating has, like everything, some goods and some bads. It helps wealthy people. It doesn't as much immediately on the first order help less wealthy people. But who's gaining from asset appreciation? When you have the stock market up, when you have private investments up, when you have assets up, you have pension funds up. Teachers' pension fund, police pension funds up,
city budgets with taxes. I mean, all of a sudden, California had a surplus.
Exactly right.
In a pandemic.
Right. And so, I think stability of the system is important for everybody. And it's as important for wealthy people as it is for less wealthy people, even if they don't feel it.
The housing market is particularly crazy because it is supply constrained, which obviously drives prices up inherently, especially in the place where you and I both live, California, where you have this crazy tax law. Whenever you bought your house, that's your tax basis. That's just dumb. We have to fix that, but it's politically untenable to do that. And then you have this NIMBYism. You can't build new houses. And then you have a third thing happening. All this asset inflation has now led to Goldman Sachs and other folks to back people like Open Door and others. And I guess Zillow is doing this now. They're buying up all the homes. So you have rich people who got asset appreciation in the stock market buying all the homes, no new homes being made, and the homes going up in value, and record low mortgage rates. That to me is this. How do you solve that problem? 4 things. It's like, talk about like a perfect storm. It's 4 waves colliding in the same direction. It's a tsunami of housing crisis.
The most important point there is lack of supply. And if you look at what happened with how many homes were built leading into the bubble, the crisis of 2008, 2009, there was a dramatic reduction of supply after 2009, and it persisted for many years. And it's going to take us a decade to catch up. So we have really a supply problem. And everything else, there are minor problems at the edges. I'm sure if you live in Austin, you don't appreciate that everyone from California is moving there and they're able to pay up because they made money in California housing, right?
At $1,000 a square foot, if you're coming from Pacific Palisades or Brentwood or Bel Air or Atherton or San Francisco, seems like a bargain.
So we're driving up prices in Idaho and Colorado and Texas and Florida. And, there's winners and losers. If you're selling a house, you're a winner.
It's amazing if you're selling it. Let's talk about
the real problem is lack of supply.
100%. I mean, I'm an investor in a company called Blockable, and it's so obvious. It's so easy to build houses in a factory, and it's so easy to build modular houses and 1 to 3 bedroom studios going up to 5 stories. They've nailed it. Katerra, was that the name of the company that went bust from SoftBank? They were kind of a mess. They never got it done, but there's other companies that are making prefab homes or mass homes, like, built in factories, and we could solve the problem. And it's going to be very interesting because there are some communities that are gangbusters allowing, the building of what they call infill units somewhere between the suburbs and the city. There's a strip mall that's dilapidated or a parking lot that you don't need parking spots anymore. And you could plop in a 4-story, 20 unit. And it's just a matter of if the NIMBYs let it happen. It's just fascinating to me. Let's talk about since it came up, minimum wage. We had Elizabeth Warren. We had Bernie Sanders going crazy. Minimum wage has to go up. Yada, yada, yada. Jeff Bezos is horrible. He's, people hate him and, he's torturing people in factories, yet he's paying $15 an hour, double the federal. And now he's in competition, and Apple, Uber, DoorDash, Walmart, Target, and your local restaurants are in a dogfight, and wages are going $20, $30, $40 an hour for jobs that were 10, 15, and 20. Discuss.
Well, let's say a few things. One is I'm going to take an interesting, different leaping off point, which is I think we have a great labor shortage in the United States and around the world. I think that labor shortage is going to continue for the next few decades. And I think it's driven by aging populations and lack of young people who are going to grow into these jobs. So if you look at the demographics globally, almost everywhere is moving into declining demographics. Yep. It's China, massively Japan. Big. It's a really big problem in Japan. It's a really big problem in China. It is not as big a problem in the United States, but for people who are anti-immigration, they should understand that immigration is one of our great strengths as a country. It has always driven our supply of labor and honestly, cheaper labor. And that's allowed us to continue to grow and thrive and prosper. And the great thing about America is historically our relative ability to integrate people. We're not perfect, but I lived in Europe for 11 years. We are much better than European countries at integration. You can ask the Turks who live in Germany how they feel about integration, or the Algerians in France.
Yeah, I was about to say the Muslims in France are second and third generation now, and they're considered second-class citizens. We have the great American melting pot here, putting cultural appropriation and that hysteria aside. Because one of the great things that we were taught is that we could all be part of this amazing soup and experiment that is America.
But when you think about the problem we have now is we have jobs that people don't want, and we have a lack of labor and supply. And so I'm very pro automation. I'm very pro robotics. And totally. I remember years ago, you invested, didn't you, in a company that was, automating coffee?
Yeah, we have CafeX, which, obviously had a heck of a time during the pandemic. They reopened in SFO. It's doing amazing. And then they pivoted, having watched what we both saw at Density, hardware as a service. Yep. The hardware, we're not selling hardware. We're selling you software. You remember those meetings where me, you, and Andrew were grinding $1,000 for the product or a software license. And, God bless Andrew, incredible entrepreneur. He figured it out. You and I were sitting there with him as he did. And CafeX now is selling the units and the software to people. So instead of them putting in 1,000 of these, what if Dunkin' Donuts, which is, can't get labor for the average tenure of a Dunkin' Donuts employee is less than a year. It's less than a year. By the time they hire them, they're gone. Now you go to any airport where there's Dunkin' Donuts on the East Coast, they need twice as many Dunkin' Donuts to service people. You see the lines at airports, even post-COVID.
If we are lacking,
they could infill these,
If we are lacking in the ability to provide jobs for people in the United States, then I can see the debate being a problem. But fundamentally, I don't believe a lot of people want to be making pizza, making coffee, filling boxes, picking
strawberries.
Yeah. And so to the extent that we can automate, but then we as a society have a responsibility for figuring out how to educate and retool and train people to take newer modern jobs and still have good income.
We have 9 million job openings, maybe 10 now. And you just think about that. Like, we were wondering what would happen with UBI, right? There was a group of people in our community like, oh, UBI, that's going to be the greatest thing ever. We kind of got a dry run of it. And if you give people enough money, and this idea that they would go to work anyway to make the incremental dollars, it's like, nope. It makes total sense. I think I nailed that one. I was like, you take people's motivation away, and now they're sitting at home with nothing to do. What is that going to do long term to a person's self-esteem? I can't imagine. I stayed home and worked like an animal during the pandemic, and I still felt bad. I still had anxiety from what was going on in the world. You have to have purpose and get out there and do some work. But the robotic work, I think it's great. We invested in a company called Root AI. It's like one of these great aha moments, which you got to love when you're in our business, right? And I'll get your aha moment. But mine was, they're like, when you use computer vision and we look at strawberries, I'm like, you pick which one is the right one to pick, right? You figure out which one is right. They're like, exactly. I was like, oh, great, I'll invest. Like, no, that's not what we're doing. That's not all we're doing. I was like, oh, what's the next piece? He goes, all right, I spent 15 years working on like soft robotic hands at MIT. We're going to actually pick the strawberry. Wow. I'm like, oh my God, that's incredible. They get bought by another company that SPACs. We triple our money like overnight. Fantastic, but also sad because I would like to belong. The other company's doing vertical farming. So a vertical farming company is like, we're going to grow strawberries outside of Boston, like right there, instead of, farming, training them in and putting chemicals on them. We take 10 days out of the process. So now you're going to have a robot look at the strawberry patch that's vertical and pick the most ripe strawberry, drop it into a bushel. Crazy.
One of the fastest growing companies in our portfolio is a company that uses robotics to grow worms in vertical farms. As of 2022, they will be the world's largest producer of worms. And so you say, well, why would I care about that? Well, the problem in the world is, one of the problems in the world is protein sustainability. And so what worms are able to do is become a protein source for fish. So in the wild, about 15% of all input that a fish takes is insects. But now more than 50% of fish are grown in fish farms, and they were getting zero insects. And so we were depleting the world's supply of things like anchovies to feed fish. So they started feeding fish carbohydrates, so wheat products. And it turns out that fish mortality goes up because they don't all digest wheat. And so they started giving hormones and amino acids and antibiotics to then prevent inflammation from hormones. And we were creating an industrial system similar to what we did with, cows and chickens in this country. And so this entrepreneur said, I think I can solve that problem if I can grow insects at scale. And so he tried 100 different types of insects. It turns out some that sound like a good idea, like grasshoppers, crickets and the like, you can't grow in really close quarters because they become cannibalistic when you do. So he had to cycle through a bunch of insect types. He settled on this type of worm. It's called a mealworm. And they could mass produce the larva. But what they do is think of stacked trays that go really high and robotic arms that lift the stack, drop in feed, drop the stack, pick the next thing up in the stack and drop the feed, and they go up and down. Then periodically they pull out a tray, flip it over a sieve, get all the manure out and put the worms back. The manure makes about 60% of our total volume of what we create, and we sell it as an organic fertilizer. At maturation, the worms are crushed. You take the liquid byproduct, and it becomes an input into pet food to make dry kibbles water soluble. And there already are products that do that. They typically come from poultry, but we're a perfect substitute for that. The most value is the dry cake powder. And that then becomes an input for fish food. And it turns out we did a 3.5-year study to prove that we could reduce fish mortality and not impact the taste of fish. Suddenly we have so much demand we can't even produce enough worms. As I said, we're building the world's largest factory to produce worms now. And we went from 0 to $100 million in bookings in 1 year.
Fantastic. That is extraordinary. I mean, you just think about all the problems we have, and you think about how lucky we are to be capital allocators and to work with these amazing founders. I am so positive, and I know you are too, about we can solve every problem if we have amazing entrepreneurs who are properly incentivized and are given the capital, and if we have the will as a society to actually deploy these exciting things, and it really is about willpower. We can correct, I believe, and I'm curious of your answer, I believe we can cure and reverse, in fact, global warming. You agree?
It's a complicated topic. I can't recommend highly enough to every reader, if you care about sustainability of the planet, to read a book called Collapse. And it's written by one of my favorite authors in the world, Jared Diamond. And Jared Diamond won the Pulitzer Prize for his amazing book called Guns, Germs, and Steel. So Collapse studies societies around the world that collapse. And why do they collapse? And like Guns, Germs, and Steel, he says, here's the proximate causes. So the proximate causes of why the West conquered the rest were guns, germs, and steel. But he says, but someone needs to ask, why did the West get guns, germs, and steel, right? So that's the whole premise of that book. The premise of Collapse is we know the proximate cause of why societies collapse is war.
Yep.
Or famine.
Yep.
Or some sort of catastrophic event like water being reduced.
Overpopulation, yep.
So, but then he says, well, what causes that? And he goes back upstream to say, what causes, why, like he looked, for example, at Rwanda and why was there genocide in Rwanda? And it came down to agriculture because they were subdividing the land so much. And every subdivision went from father to son, and it usually went to firstborn son. And they would subdivide and subdivide and subdivide the land as population grew to a point where they could no longer hand out land to their offspring. And they had a limitation on the number of acres of farmable land, and it started leading to civil conflict. So he goes back up to looking at things like agriculture. And one thing he studied was Easter Island, the Moais, and why did Easter Island collapse? So Easter Island went from this really religious place that had gods and norms and rules, and then over time they became cannibals and killed each other and ate each other. And see what led to that. And what they did is they studied the diets of the middens of they studied the middens to determine the diets of what people ate. And what they figured out was the first thing they do is they cut down all the trees. And once they cut down all the trees, they no longer had fish in their diet because they no longer could build boats to have fish.
Oh my God.
And so their calories were reduced, and therefore their output was reduced, and therefore they led to civil conflict, and their entire religion was wiped out, and they became cannibalistic. And so anyway, this book, it's a wonderful book. And he basically says, oh, you did? Okay. So he talks about a theory called Malthusian theory, which is the more you produce in agriculture and output, the more population will grow to fill that. That's the Malthusian theory.
It's like induced traffic. You build more roads, people travel more.
Exactly right. But what he said is you need a combination of technology, but you need societal change. You need people wanting to consume less. And I think that's the other area. And that's what gives me great hope about Gen Z and people coming behind Gen Z is they're growing up with a culture of wanting to drive electric cars, wanting to consume less, wanting to have lower carbon footprint, wanting to find ways to not have to import their products from around the world that has carbon emissions. And wanting less. And I think that's got to be the world we live in the future.
You know, it's crazy. I grew up, and you and I grew up, we're both Gen Xers, where we really didn't think about this too much. We saw Greenpeace kind of over here doing, saving the whales. There was some, activity on this. There was a pulse, but it wasn't like today. And I got the bug from my children who are absolutely militant about plastic straws because they understand it kills turtles and, the damage it does. So we have metal straws at home. We have paper straws at home. We do not have plastic straws. When we go to a restaurant, if they give us plastic straws, we hand them back. We ask them preemptively, please do not give us plastic straws. And increasingly people say to us, we don't serve plastic straws, sir. But that 5 years ago was a distinct difference. And then I started getting crazy, Mark, because I made a little bit of money and I love beverages. So I start ordering Topo Chico, and I started ordering my Bundaberg diet ginger ale. I got these bottles and cans of everything I like. I'm in love with beverages. Then I realized, wait a second, I'm destroying the environment with all this stuff. So then I said, you know what? Enough. I love my Topo Chico. I don't know if you drink that sparkling water.
So I
Topo Chico, is it called?
Topo Chico. I put it on. I put it on Twitter.
Yeah.
And I said how much I loved it on Twitter.
Yeah.
For which point I started getting bombed by several people telling me that it has the worst chemical rating of virtually any carbonated water drink.
That's terrible. And it's got so many bubbles.
People sent me the links to it and why you shouldn't drink Topo Chico. And I can't claim to be an expert, but I clicked and read the articles and it all seemed plausible to me. So I'm kind of back to
what's so good about it is it had so many bubbles in it.
It tastes good. It tastes good.
So here's what I did. I was like, I love these bottles. I went on to Amazon. They make silicone caps that look like bottle caps, like old-timey bottle caps. I get the 12-pack of Topo Chico. After I use it, then I put cold brew coffee, iced tea, or water in them, and I put the rubber caps back on them. And like I'm like a maniac, like I'm like some crazy environmentalist. My refrigerator, I don't drink wine, so I have a wine fridge that was installed in my house. It's filled with these bottles with ice water in them. So now my girls go and they drink ice water from the Topo Chico bottles. I'm just
my wife went one step further, which is she bought one of those sparkling water
Yes, I have that
slash
too,
Coca-Cola makers or whatever.
Yes.
I don't drink from it,
I
but
hate
she
them.
does. She does it because she doesn't want to have to buy as much plastic.
You don't have to carry as much. I think, and all of this, I mean, you just think about solar, you think about Tesla battery packs, you think about Teslas. We are here. We're on the cusp of it. It just requires us to focus on an innovation. Listen, Mark, it's been over an hour. Great job today. I love being in business with you. I love having you as a friend. Love having you on the pod. Let's just do this again in 6-12 months, whenever you can spare the time. The audience loves it. If somebody is looking now for the new A, not the new A, I'm sorry, the seed, and they want to get that advantage of having Mark's Series A wisdom and dexterity with the new Mark, earlier Mark, coming in earlier and strong, what's the best way for them to pitch you and the best stage for them to be at?
Well, listen, I still believe that trying to find ways to get introduced to VCs is a good idea. It's not, I'm on Twitter, so I respond to tweets, right? Like you can reach out. If, there's the old saying, you should give before you get. So the best way to endear yourself to someone you want to get to know is to find something of interest to them and put information in front of them. They're going to notice you. So I'm very active. I'm very public. I don't mind interacting with people. I'm on the road now. I'm traveling. I was in Austin 3 weeks ago. I was in San Francisco yesterday. I'm in Palo Alto today. I'll be in DC and New York. I'm getting out there, right? Like I'm being careful. I understand there's COVID, but I'm getting out there. So I'm available. The reason
you removed obesity from your risk factors. You look so good. I'm so happy for you.
I appreciate it. Thank you.
What's the total weight loss at this point? So at peak, I lost 70 pounds. Right now I'm closer to 60. And I've been focusing on trying to do weight gain. I'm trying to do muscle gain rather than weight loss. I watch you on the social. I see you with your kids. You're out there doing stuff. And you used to be fat and tired and eating donuts with me at board meetings. And now look at you. You're svelte. You look great. You look 10 years younger. And your energy level and your positivity also goes up, right? When you lose it. I'm on the journey right now.
But thank you, and I'm happy. Next time I come on, I can give a ton of fitness suggestions. I give a small plug to daily habits and the need to have daily habits. I hold myself accountable with an app called Streaks. There's plenty of them out there, but I have every day I have to do push-ups, abs, take my meds, study French, and do cardio. Those 5 things, and I just track it on my phone. And like if at 10 o'clock, I'm like, oh, I kind of want to wind down and, sit and watch TV. And I'm like, oh, fuck, I haven't done my abs yet. It just forces me to go do it. Right.
I do my abs, then I watch my Netflix.
Exactly. But, so I look a bit mashugana to my wife, who's like, God, why at 10:15 do you always have to go do your abs? I'm like, because I haven't done them today. Right. Like, so it's okay to have a little bit of neurosis over good, positive things.
All right. Listen, brother, it's been a great episode, and we'll see you all next time on This Week in Startups. Bye-bye.